Welcome back to this special deep dive episode of the Daily Crypto Roundup. Today we're getting into one of the most important forces in the entire crypto landscape: interest rates. Not the most glamorous topic at first glance, but make no mistake. Interest rates decide bull markets, bear markets, liquidity cycles, exchange volumes, institutional flows, risk appetite, and honestly, the emotional state of crypto Twitter on any given week. You can talk about narratives, halving cycles, ETF approvals, meme coins, influencer hype, but none of it works against the gravity of global interest rates. They are the invisible hand underneath everything. So today, we're going to walk through exactly how interest rates move crypto, why the last 2 years were so brutal, why the next 2 years could be explosive, and what every investor should understand about the macro machine behind their favorite coins. Before we begin, I want to give a quick shout out to 2 listeners of the show who have genuinely lifted the content over the last couple of weeks. RR84 and Pavel G. You two have been absolute legends, sending in deep dive ideas, asking smart questions, and helping push the show to a higher level. As a thank you for your contributions, both of you will receive 10 XRP from us this week. Consider it a small token of appreciation, and for anyone else listening, get involved with the community, throw your thoughts and ideas in the comments, because we'll keep picking people who add value, and you never know when it'll be your turn. Just before we get into the macro story, a quick note, and we'll keep it brief. Since we moved podcast providers, Spotify has throttled the algorithm a bit. It's nothing to do with the listeners or the content, it's just how the system works when you switch feeds. So the easiest way to help push the show back up is simple. Give it a 5-star rating. Takes 2 seconds. And as we said in the roundup, if we hit our target before Christmas, we're giving away 50 XRP each to 2 listeners. If you've already rated the show, just comment "done" so we can add you in. But that's it. No sales pitch, no fuss, just a quick push, and we move. Right. Let's get into today's deep dive: how interest rates control the entire crypto cycle. To understand this properly, you need to start with a principle that drives every modern financial system. Money flows where it gets treated best. When interest rates are high, money gets treated best in safe, boring places: government bonds, treasury markets, money market funds. When interest rates are low, money goes searching for higher returns: stocks, real estate, tech companies, crypto, and anything with growth potential. The problem is that crypto isn't just a risk asset. It is the highest beta major asset class in the world. It reacts fastest, it moves furthest, and it takes the biggest beating when conditions tighten. So when central banks raise interest rates, crypto doesn't just cool down, it gets smacked. To understand why, imagine the global economy like a giant funnel. When interest rates are low, let's say close to zero, the way they were between 2020 and 2021, liquidity floods into the funnel. Borrowing is cheap. Venture capital pours money into startups. People refinance homes and free up cash. Institutions rotate into tech and growth assets. Retail investors feel wealthier and more confident. And that excess liquidity spills into speculative markets, crypto being the biggest beneficiary. Every major bull run in crypto shares the same underlying condition: cheap money. The 2017 run happened after years of ultra-low rates. The 2021 run exploded after the fastest monetary expansion in modern history. Even Bitcoin's earliest cycles were amplified by macro conditions nobody in the space was paying attention to at the time. But then comes the turn: the rate hikes. And this is where the whole system flips upside down. In early 2022, central banks across the world began raising interest rates to fight inflation. The US went from 0% to over 5% at the fastest pace in 40 years. That wasn't normal tightening, it was a shockwave. And when that happens, liquidity doesn't slowly drain from crypto, it evaporates. Institutions pull risk off the table first. Hedge funds unwind leveraged positions. Retail investors stop feeling rich. Borrowing costs jump. Corporate expansion slows. And the money that once poured into crypto, it suddenly has a better option: guaranteed, risk-free yield in government bonds. If you can get 5% with zero risk, or risk everything in crypto for maybe 15% and possibly lose 50% instead, the rational choice changes. That's what people forget. Bull markets feel emotional, but the underlying mechanics are always rational. Liquidity flows where the reward-to-risk balance makes sense. And as rates climb, that balance shifts dramatically. We're going to pause here briefly for a quick break from today's sponsor. And when we come back, we'll break down exactly what happens to Bitcoin, Ethereum, and the altcoin market when the rate cuts finally begin, and why this next cycle could be completely different to anything we've seen before.
Avoiding your unfinished home projects because you're not sure where to start? Thumbtack knows homes, so you don't have to. Don't know the difference between matte paint finish and satin? Or what that clunking sound from your dryer is? With Thumbtack, you don't have to be a home pro. You just have to hire one. You can hire top-rated pros, see price estimates, and read reviews all on the app. Download Thumbtack today.
What can 160 years of experience teach you about the future? When it comes to protecting what matters, Pacific Life provides life insurance, retirement income, and employee benefits for people and businesses building a more confident tomorrow. Strategies rooted in strength and backed by experience. Ask a financial professional how Pacific Life can help you today. Pacific Life Insurance Company, Omaha, Nebraska, and in New York. Pacific Life and Annuity, Phoenix, Arizona.
Now let's get back into it. Interest rates don't just affect investor sentiment. They also affect the valuation structure of every growth asset. This is where we need to talk about discounted cash flows. But don't worry, we're not going to make this a math lecture. Here's the simple version. When interest rates rise, the value of future gains falls. For stocks, that means future earnings matter less. For real estate, future rental income matters less. And for crypto, where most assets don't produce cash flows at all, it means the implied promise of future adoption becomes worth far less. That's why every time interest rates spike, Bitcoin and Ethereum fall sharply. It's not because the technology gets worse or because sentiment suddenly collapses without reason. It's because the macro machine reprices everything that relies on future value. But let's zoom in on crypto specifically, because high rates hit this industry harder than others for three major reasons. First, crypto thrives on liquidity. It needs high volumes, active trading, inflows from both retail and institutions, and a thriving derivatives market. High rates destroy that environment. Instead of trading, people hoard cash. Instead of investing, institutions become conservative. Instead of building, companies cut back. Second, leverage. Crypto has more leverage built into its system than any other modern asset class. Exchanges rely on it. Traders rely on it. Market makers rely on it. And when rates rise, leverage becomes more expensive and more dangerous. This forces liquidations, cascades, and volatile down moves. Third, narrative sensitivity. Crypto is hypersensitive to the macro narrative because it doesn't have earnings, dividends, revenue streams, or bonds backing it. Its value is narrative-based, adoption-based, and expectation-based. When rates rise, the narrative becomes tighten, restrict, risk off, and crypto narratives collapse with it. This is why 2022 felt like an apocalypse across the space. Rates didn't just rise, they exploded upward at historic speed. And crypto didn't just correct, it reset. Dozens of companies collapsed. Venture capital froze. Exchanges lost volume. Retail participation dropped to decade lows. It was a cleansing, but for many people, it was brutal. Now, here's the important part. And this is where we shift from the past to the future. When rates peak, and when central banks begin signaling cuts, crypto begins to bottom. Not when they actually cut rates, not when the liquidity is flowing again, but the moment the narrative changes. If you look at every major crypto cycle, the bottom forms around the moment the central bank says something like, "We believe rates are now sufficiently restrictive." Those words are like flipping a switch. It means no more surprises, no more rapid hikes, and no more tightening. For investors, it signals the start of a transition from a restrictive environment to a neutral or supportive one. Crypto doesn't wait for the cuts. Crypto front-runs them. You can see it in the data. In 2015, 2019, and 2023, the market bottomed right as the tightening cycle ended, not when cuts actually began. It's because crypto traders are forward-looking. They price in future conditions, not present ones. And today, we are in one of the most interesting macro positions crypto has ever been in. Central banks are at or near peak rate levels. Inflation is easing in most major economies. Rate cuts are being discussed, not promised, but placed on the horizon. And the market is starting to quietly position itself for the next wave of liquidity. Now, here's where things get deeper. Interest rates don't just affect institutional flows and macro valuations. They affect how people behave on an emotional level. When money feels tight, people take fewer risks. When money feels loose, people chase opportunities. Crypto is emotional. It amplifies confidence and fear. Low rates amplify greed. High rates amplify caution. When liquidity flows freely, meme coins pump, NFTs explode, Solana seasons begin, liquidity pairs multiply, leverage spikes, and market caps go vertical. When rates rise, all of that evaporates. The emotional tone of the market shifts. The industry becomes defensive rather than explosive. And here's something most people overlook. Interest rates also determine how attractive stablecoins are. When bond yields hit 5%, stablecoin issuers earn huge returns on reserves, but retail users get nothing. This creates friction. Some stablecoins must increase yield to stay attractive. Others rely on utility rather than return. But the landscape shifts dramatically. We are now entering the stage where macro conditions are beginning to pivot. Rates are still high, but they're not rising. Inflation is falling. Economic growth is slowing. This is exactly the environment that precedes rate cuts. And historically, rate cuts lead to massive rotations into risk assets. At the same time, crypto is far more institutionalized today than at any point in its history. ETFs exist for Bitcoin, Ethereum, and now XRP. Major banks are entering the tokenization space. Hedge funds now treat crypto like a macro asset rather than a curiosity. And all of this means that the next time liquidity expands, crypto won't just rise, it will accelerate. Right. Let's get into the part that everyone wants to understand. What happens next? What happens when rates finally come down? Here's the truth. Not all rate cuts are equal. If central banks cut because the economy is collapsing, crypto doesn't benefit, at least not immediately. People forget that in 2008, the Fed cut rates aggressively, and markets still fell. Because in that environment, liquidity doesn't expand. It freezes. It goes defensive. But when central banks cut due to softening inflation and stabilizing growth, that's the golden scenario. That's the exact setup that lit the fuse in 2020 and 2021, and it's the setup we're slowly approaching now. When rate cuts begin in a healthy environment, liquidity increases. Borrowing becomes cheaper. Investors rotate into growth assets. Institutions seek higher returns. Retail confidence rises. And crypto, being the most reflexive asset class on the planet, responds violently to the upside. Bitcoin typically leads the charge. It acts as the macro thermometer for the entire space. Once Bitcoin breaks out, Ethereum follows with leverage. And then the altcoin market wakes up. Liquidity spreads outward. Risk-taking increases. Narratives form. Tokens pump. Projects attract funding. Cycles begin. This is why understanding interest rates isn't optional. It's essential. Crypto doesn't move randomly. It moves with global money flows. And global money flows move with interest rates. In summary, the entire crypto market lives inside a macro engine, and that engine is controlled by rates. When rates rise, liquidity dies. When rates peak, bottoms form. When cuts begin, cycles ignite. Thank you for listening to this deep dive. Make sure you follow the show, leave a rating, and jump into the comments. And to our crypto family, keep listening, keep contributing, and as always, we will see you at the top.